This video is over payout policy. I'm your professor, Dr. Stephen Haggard. There are essentially two ways that you can make money from investing in stocks. The first would be to receive dividends, and that would be a periodic payment of money from the firm. The second would be a capital gain. And a capital gain is where you sell the stock for more than you pay for it. And a capital gain is more likely if the firm retains the money it would have paid in dividends and instead invests that money in positive net present value, thus increasing the value of the firm. Now, historically, in the United States, dividends have been taxed more harshly than capital gains. And so you might think dividends historically would have been a pretty rare thing. However, we tend to continue to see dividends regardless of these harsher tax regimes. And the question becomes, why might that be? I'm going to use myself and my parents here as an example of why some people might prefer capital gains and other people might prefer dividends. I'll start with me. I am a professional and I get paid a good wage to do what I do, so I do not need dividends at this point in my life to finance my consumption. So I am pleased for a company instead to invest that money and prepare me a capital gain for down the road. I'll be taxed at a lower rate when I sell that, I hope, and also I'll be able to choose the timing of when I receive that money. Now let's think about my parents. My parents are in their 70s and they don't work anymore. So the money that they have coming into the house comes from Social Security and from my father's pension plan and from dividends that they receive. This is the money that they depend upon for their consumption needs because they have no employment income. So they have a need and a desire for a regular payment of money that they can use to finance their consumption needs. Now, you could make the argument that they could just sell a little bit of their portfolio every month to fund their consumption needs. We would call that homemade dividends. But apparently, the administrative cost and the hassle of doing that outweighs the negative tax consequences from this kind of policy. And so they prefer dividends, and I prefer capital gains. And as long as you have groups of people that prefer one or the other, we will continue to see companies choose their payout accordingly. We call this the clientele effect. Okay, so what do we know? It's always shocking to students to find out how little we know in finance. And if you've watched my video on capital structure, you'll know that we don't know everything about capital structure. And in capital structure, we said it might even be irrelevant due to this homemade leverage that people can create in their own portfolios. Now, we know there are lots of assumptions that have to be made for that to be true. But similarly, in payout policy, we have this concept of homemade dividends. And if homemade dividends are a realistic option for people, then perhaps payout policy doesn't matter either. But we continue to see people concerned about payout policy and choosing different policies with conviction that they are doing the right thing for their company and their shareholders. And so there must be more going on here than we currently know about. One more link between payout policy and capital structure. Think about where retained earnings come from. Retained earnings are what's left over of net income after you pay dividends. And so if you pay dividends, then retained earnings is lower. Retained earnings are part of the common equity of the firm. If we pay out dividends, then we would need to find the money somewhere else to invest in positive net present value projects. What are the likely suspects there? Well, first of all, we could issue debt, bonds, or borrow money from a bank, or we could issue additional shares. But we see that both of those from a transactions cost standpoint are far more expensive than simply using the firm's retained earnings. And so we see that if a firm has lots of positive net present value projects, it's far less likely to pay dividends because it can use those funds instead to invest in projects that will create capital gains for the shareholders down the road. Over time, our understanding of dividend policy, payout policy has improved quite a bit. And so there are a few things now that we know are definitely impacting payout policy. And here's just a short list. I know I'm missing some things. We have taxes. We have transactions costs. In other words, the cost to go out and issue new securities to replace that money instead of holding it inside the firm. We have asymmetric information. Sometimes we might see that managers would use a dividend or a share repurchase to send a message to the market about the quality of the firm. And so that's another reason we see differences in payout policy. We have clienteles, as we mentioned earlier, people like my parents who prefer dividends versus people like me who prefer capital gains. And we have uncertain cash flows. And uncertain cash flows would tend to make us want to steer away from paying a dividend and might steer us towards something like share repurchases if we were interested in putting money back to the shareholders. Knowing all that, we still have a long way to go before we can predict perfectly what kind of payout policy a company will choose given everything that we know about the company. And so just like many other topics in finance, we continue our search and we learn something new every year. So what are the big questions in payout policy? First, why do firms choose to pay out capital to their shareholders? Are firms required to do so? Actually, they're not. In fact, if a firm has positive net present value projects, the shareholders should prefer that the firm invest in those projects instead of paying out capital to their shareholders. And what are the different ways that firms return equity to shareholders? We can think of at least two broad headings here: dividends and share repurchases. And under each of those broad headings, we'd see narrower subheadings. Under dividends, we would see our regular cash dividends. And we would see special dividends such as liquidating dividends, in which case the company is liquidated and the remaining money is paid out to the shareholders. And we have different types of share repurchases as well. We have open market repurchases where the company says that they are going to buy the shares on the open market, meaning at market price. We have tender offer repurchases where the firm offers a certain amount of money for each share to be repurchased. And then we have Dutch auction repurchases. So we have at least three types of repurchases as well. All of these are meant to put cash back into the hands of the shareholders. So what constraints might influence the timing or form of the payout? First of all, let's talk about taxes. When we pay out a dividend to the shareholders will owe taxes on that dividend. Now the amount of that tax, percentage-wise, has changed over time, but it still creates a tax liability on the part of our shareholder, and that's a tax liability that they can't escape. Unlike with share repurchases might create a capital gains tax situation for our shareholders, but our shareholders can easily avoid that capital gains tax by not participating in the share repurchase because they choose not to sell their shares back to the firm, thus avoiding any taxes at the current time. So taxes are important. Also, transactions costs for issuing new securities are important. If we can issue new securities without any transaction costs whatsoever, then our payout policy can be much more liberal. We can pay dividends to people who want dividends. We can repurchase shares from people who want their shares repurchased, and we can finance all of this by issuing new securities in the market at no cost. Unfortunately, transactions costs are a real thing and must be considered. And then finally, we need to think about the cash flows of the firm. The cash flows of the firm are a big determinant about payout policy. If we don't have cash to pay dividends or to repurchase shares, then we are far less likely to try to engage in that sort of activity. And so the magnitude of the cash flows and the volatility of the cash flows that we expect going forward are big determinants of when we pay out and what kind of payout mechanism we choose. We have two readings for this unit. The first is from Sudipto Bhattacharya, and it is the Imperfect Information Dividend Policy and the Bird in the Hand Fallacy. Now Bhattacharya, of course this is a fine paper, but one thing that I would critique about it is that he doesn't do a good job about telling us what the bird in the hand fallacy is. And so let's think about the old American expression, a bird in the hand is better than two in the bush. What does that mean? $1 in your hand for certain is better than 2 uncertain dollars. And so what the bird in the hand fallacy says is the reason we have dividends is because shareholders would rather have the dollar now instead of waiting for a capital gain perhaps from leaving the dollar invested at the firm. And Bhattacharya goes on to build an argument. In fact, he calls that a fallacy. But if you look at Jensen 1986 regarding free cash flow and agency behavior, it may turn out that the bird in the hand idea is not such a fallacy, that there may be some truth to that. So I encourage you to also go back and read that paper. Now regarding what Bhattacharya is actually saying here, he's saying dividends act as a signal. And when are signals valuable? Only when there is information asymmetry between two groups. In this case, the managers of the firm have more information about the prospects of the firm than the investing community. And how can the managers transmit the information about good future earnings, expected earnings, to the investors in a credible manner? It's not credible just to stand up and say our future's great and we're going to make lots of money. You in essence have to put your money where your mouth is, because basically anyone can lie and say that the future looks bright for their firm. And so the dividend in Bhattacharya's model is a costly signal of a bright future for the company. Now I want you to note that the tax assumptions that are made in this paper are no longer true, because the tax laws in the United States have changed since 1979. So I would encourage you to go to the IRS website to learn what the latest is on dividend and capital gains taxation in the United States. Our second paper is from Stevens and Weisbach, Actual Share Reacquisitions in Open Market Repurchase Programs. This paper is worth reading simply for the institutional detail it provides about repurchases, but it's actually much more than that. And I'll get to that in a minute. But first let's talk about the three types of repurchases that there are. There are open market repurchases, Dutch auction repurchases, and tender offer repurchases. A tender offer is where the firm offers a set price to repurchase shares. Contrast that to an open market repurchase where they announce that they plan to buy back a certain percentage of their shares at prevailing market prices, but they don't set a time limit on it or tell you what day they're going to do it. And so therefore, the firm can opportunistically repurchase their shares. For instance, when share price drops a bit, they can repurchase more shares and do so at a favorable rate. The open market repurchase, usually upon announcement, is greeted with a positive stock return. But here's the problem. There are a couple of problems. First of all, how much do firms actually repurchase after they make one of these announcements? At the time leading up to Stevens and Weisbach's paper, popular press was saying that companies did not actually do much in the way of repurchases, and this was just a way to fool investors. And so Stevens and Weisbach set out to figure out how much actually gets repurchased. So that's the crux of this paper. And what they find is pretty astounding. So I encourage you to read the paper and to pay careful attention to their evidence on whether or not the market is fooled by announcement of repurchase programs in which managers truly have no plans to repurchase any shares. It's not actually possible to fool the market. The market is smarter than that. And so there are some really interesting findings here. The paper overall is well written and easy to read. It's actually one of my favorite finance pieces of all time.